Good afternoon. It is noon, 12:01, so it is officially afternoon. Thank you so much, everyone, for joining us today. This is our intro to blockchain event, and we're honored to have Bill Wolfe and Bradley Lai, both from EY, and experts in blockchain. And I'm not going to pretend to be one because I really can balance my checkbook, so blockchain's a little bit out of my league. But we're in good hands today, and with Bill and Bradley. I'll let them introduce themselves and let them take it away. Now, just as a reminder, this is being recorded though, so that if you didn't get everything in terms of what they're saying today, we'll be uploading this to our YouTube channel, so you have an opportunity to rewatch this. And if you have any questions, please feel free to type those in. I'll go ahead and monitor the chat and raise any questions the audience brings to light. So Bill and Bradley, take it away.
Awesome. Thanks, David. Hi, everyone. It's a pleasure to be here today. Like David said, my name is Bill Wolfe, and let me just share my screen real quick. And let me move that. All right. So yeah, pleasure to be here. Let me just do a quick introduction for myself, and then I'll let Bradley introduce himself as well. But my name is Bill Wolfe. I'm a manager at Ernst & Young. I've been with the firm for approximately 7 years, and I am based out of the Philadelphia office. Live in Jersey, haven't been to Philadelphia in quite some time now, but I still am based out of the Philadelphia office. And I work in global assurance innovation. And essentially what that means is I work as part of a special group in our EY global practice where we focus on the future of auditing and sort of what are those emerging technologies going to look like, and how are we going to audit them, and what are the services we're going to deploy from an assurance perspective on these emerging technologies. So that what I focus on in my global assurance innovation role is I focus on blockchain, and the product I really support, and you might hear a little bit about this as we go further down the line, is our blockchain analyzer. And our blockchain analyzer is our tool that we use to audit cryptocurrencies. I'll explain a little more about what that tool is a little further down the line, but that's a lot of what I do from at EY. So Bradley, you want to quickly introduce yourself?
Yeah, so hi everyone, my name's Bradley. I'm like Bill, I'm an insurance manager. I'm based out of Los Angeles, California CPA as well. So I primarily work in the assurance practice, which is EY's audit practice. And one of the additional things that I do, in addition to kind of serving clients, is I work as a digital coach. And that kind of means, implementing data analytics, next generation technology, and, blockchain obviously will be a big part of that in the future. So it's really kind of informing people, hey, what is blockchain? How is it impacting our work? And, what's kind of up and coming in terms of technology, not just blockchain, but kind of also data analytics. So.
Perfect. Thanks, Bradley. So what we're going to do is we'll kick things off with a quick video, and this will be an introduction to the blockchain session. We have a lot of content, but of course, we gladly accept any questions or comments. So feel free to put that in the chat. Bradley and I will continue to monitor it, and we'll gladly answer any questions along the way. So let's kick things off with the video. I got to stop share and then reshare because I screwed that up, didn't share computer sound, so let me do that real quick, and then we exit out of this, and then we can get to the video. All right, so let me maximize this, and then
blockchain isn't.
Let's play that. So it's not coming across. Sorry, let me stop sharing again. Screen share.
blockchain
Can you hear
is
that
an
on your side?
innovative digital technology that has the
Cool.
potential to change the way we connect real-world physical assets to their digital representations and then transfer those assets among a network of peers. If we think of each transfer or movement of an asset as a transaction, we can use a blockchain to keep track of those transactions in a way that everyone can trust. A blockchain is essentially a type of database known as a distributed ledger, which is decentralized. That is, there is no central administrator. Whenever a user records a transaction on the database, it is time-stamped and recorded on a block. Each data block in the ledger is linked to the previous one by a cryptographic algorithm called a hash, and the linked blocks form a chain, hence the name blockchain. Each node in the network holds a copy of the distributed ledger, and the data is replicated and synchronized across all copies of the ledger in real time. The participants in the network each have a unique identification called an address. This allows users to interact with data on the blockchain according to a set of rules that are predetermined and 100% enforceable. Any transaction initiated by a user from an address is signed with that user's digital signature, ensuring that it was them who initiated the transaction. In addition, these participants do not need to be users as we traditionally think of them. The address can belong to a physical location, a piece of equipment, or a container. With some careful planning, we can also assign properties to each address, such as the physical location. What is unique to a blockchain is that the addresses on the network do not necessarily need to trust each other to be able to rely on the data that they share. This means that multiple business partners can transact on the blockchain without the risk that one party could manipulate the data without others knowing about it. Just as the blockchain is secure from within, it is protected from outside attackers as well. Because the ledger is both shared across all nodes, an attacker wanting to alter the data in it would have to hack a majority of the nodes in the network and overwrite their data simultaneously. Even if they had succeeded, users would be able to see that data had been tampered with. This high level of security and anti-censorship is one of the attractive features of blockchain and is a reason why it is increasingly being used for a range of functions where it is important to transmit data securely, or where it's beneficial to have a clear audit trail of exactly which transactions have occurred for a specific set of assets. Blockchain is changing the way individuals, businesses, and governments exchange and trust data. The network effect of the blockchain is that as more of the world begins using it, the network becomes more secure and our transfer of assets becomes more fluid. As we begin embedding rules and logic directly into the blockchain via smart contracts, certain aspects of our day-to-day transactions will become autonomous, allowing us to move faster and with more control.
All right, so that's a quick summary of what blockchain is, and we'll get a little more into each component. So Bradley, let me just swap that. Cool. You want to take it away?
Sure. Could we go to the next slide, please?
Yep.
So one of the things that, sorry, sir, echo. Bill, can you mute for a second?
Yeah.
All right, thanks. Okay, yeah, I think that works. So one of the things that we wanted to talk about, obviously when we talk about blockchain, I think the first thing that comes to everyone's mind is Bitcoin, right? Like Bitcoin's of news, it's $17,000, and it's like, hey, why not buy Bitcoin like 5 years ago? And that's probably the first thing that everyone thinks about when they think about blockchain. And what we want to share a little bit about is really the underlying technology behind Bitcoin, right? Like blockchain. So why is blockchain so important, and how is it going to change how businesses operate? Because I think, there's a lot of news about, Bitcoin and how it can do certain things. But, from a business perspective, blockchain really has a large potential impact as well. And maybe to best understand where blockchain is so valuable and different from what we have now, I think a good starting point would be what do we have now? What are businesses using? And for the past 20, 30 years, we started with enterprise resource systems, right? I'm sure you've heard of Oracle, SAP, all of these other systems that companies have to talk to each other. And this is kind of how different departments within a company will talk to each other, right? For example, say, let's just use Coca-Cola as an example. So, the merchandise, the inventory department of Coca-Cola can talk to the accounting department and be like, hey, we have this much stuff in stock, or, we need to order this much, raw material, and we need to order it from a supplier. And then the accounting team will be like, all right, I'm going to go pay a supplier this much and, get this much in stock. So the ERP system, was really put in place for the past 20 years. And that was something that, companies have really developed upon. And that's something that, is a part of our, modern day business operations. And, you'll probably see those in, your classes, and the importance of ERP systems. So what makes blockchain different from an ERP system? I'll start with what's similar. So first thing is, it's also a database of information, right? So like how an ERP system will store information, so records, like accounting records, inventory records, just different records of a company. Blockchain similarly will do that. So blockchain is also a database of records. Essentially, we can think of it like a ledger, right? So it contains information about, transactions, information, things like that. So it's a database. What makes it different? So the first starting point, shared ledger, right? So, the ERP, SAP systems, when we think about it, historically they've been hosted on a server, right? Now they're on cloud, so it's technically more remote, but historically they've been hosted by a server, and there's a central kind of authority behind it, right? So for example, there's an SAP company that actually runs the system, and they're kind of responsible for the development of the software. And they're kind of the central authority for kind of making sure that everything's appropriate. Blockchain's a little bit different in this case, where shared ledger means that, we'll touch upon this a little bit, that different people can participate in the network, and there's not necessarily a central authority like there is with, traditional ERP systems. So being a shared ledger means that, we'll touch upon that. And it was in the video that, there's kind of more security with regards to a shared ledger, because there's kind of more people involved. You're less kind of reliant on a central authority like you would be with Oracle and SAP, for example. So that kind of touches upon security, which we'll also touch upon later as well. Can we go to the next slide, please? So I know there was a lot of technical language in the video just now, so maybe we can kind of recap on kind of the basic fundamentals of blockchain. So protocol, the way that I would kind of analogize what a protocol is, I would think about, for example, Bitcoin, right? Bitcoin is its own kind of blockchain, and it has its own set of rules and regulations. So that's essentially its protocol. Maybe some of you guys have heard about Ethereum. Ethereum's a separate kind of blockchain, kind of cryptocurrency, right? So that has its own protocol too. So each blockchain will have its own protocol, kind of similar to how ERP systems will have their own rules. So for example, if certain people can access certain records, for example, HR records would typically only be, access would be restricted to certain people in the HR department. The next big component of a blockchain is a node. So again, one of the things that we were talking about earlier is a shared ledger, right? Everyone is kind of a participant in the system, and the blockchain way of calling it is a node. So for example, if there's like 15 of us around, so all 15 of us would be on this node. Each of us would be a node and kind of serve as a part of the network to kind of secure the network. So cryptography, that kind of plays into the security of the network. So there's kind of a mathematical way to kind of secure the network. So we'll touch upon that a little more detail as well. And consensus. So consensus kind of goes hand in hand with kind of the shared ledger. Consensus is basically kind of I would think of it how the majority of people, once they agree upon a transaction, we'd agree upon it, and that's how we can validate a transaction. That's kind of the consensus mechanism of blockchains. And I think there's a little bit more on that later. Can we go to the next slide, please? Okay, so what does a transaction on the blockchain look like? So from a business perspective, maybe we can give an example. So Bill will touch on this in a little bit, but I'll use Ethereum as an example because I think, our firm believes that Ethereum is going to be the next big kind of public blockchain technology that we're building upon. So I'll just use Ethereum as an example. So what we think would happen one day is, let's say Coca-Cola, right? They want to order, 5 tons of sugar from a supplier. So Coca-Cola is going to be party A. So basically, they're going to broadcast to the Ethereum network. They're going to be like, hey, I want to buy 5 tons of sugar from the supplier. And then, assuming that each of us are nodes one day, if we're validators of the transaction, we would basically, assuming we'd basically be computers on the network, basically saying, hey, Coca-Cola wants to buy 5 tons of sugar from the supplier. And then the consensus that I was talking about earlier is, say there's, 15 of us here. Say there's like 8 or 10 of us that basically have recorded Coca-Cola wants to buy 5 tons of sugar from a supplier. Then basically that transaction would get added to the blockchain, and all of us would have a record of it, right? So, all of the nodes would have a transaction saying Coca-Cola is buying 5 tons of sugar from a supplier. So that's kind of the next step of where the approved transactions are bundled into blocks and then added to the chain. And again, this is an immutable and transparent record. And that's kind of inherent with the blockchain technology, is that once a block is added into the blockchain, there's no way to go back and change it unless you're able to essentially hack the network, which again, due to the shared kind of distributed nature of blockchain, would be very difficult to do. Because again, if going back to the example of there were 15 of us, you would have to hack, over half of us in order to basically change the records, because we each have our own copy of the records. So, and then, once this record is added, we all say Coca-Cola is buying 5 tons of sugar. Then basically, essentially in this case, the cryptocurrency or whatever method of payment that Coca-Cola is using would automatically get executed, and it would get sent to the supplier's wallet, essentially, basically being paid for the 5 tons of sugar. Can we go to the next slide, please? And again, if there's any questions, please feel free to use the chat panel, because there's a lot of kind of technical concepts, but hopefully we can provide a high-level overview of what really blockchain is and kind of the benefits of it. So cryptography. So we were talking about earlier what makes blockchain secure, right? So there's this concept of public and private keys, and when there's kind of a transaction going on. So let's just use Coca-Cola for an example, right? So on the public network, we know who Coca-Cola is because they have this identity that's established. So when on the network, we're able to see what's called the public key, which is basically Coca-Cola's identification. So it's like when we see the public key, that this public key is transacting with someone else, we know that that public key is Coca-Cola. And there's kind of a private key, which is the flip side to that. So we don't see the private key, but that's essentially the way for Coca-Cola to prove that they're actually Coca-Cola, right? So the people who are, using the key there are like, hey, we're Coca-Cola, so we have this private key and we can prove it. But, for everyone else, once we see the public key, we're like, hey, that's Coca-Cola. They want to transact with someone. And that's kind of, we know who's who. It's kind of like, if you're buying something, you're paying for something with a credit card and you're signing it, right? Your signature is basically the public key to the eyes of the merchant and the Visa processor, because they're like, oh, looks like he bought something here. We know that's the right person. So that's kind of how the public-private key works. So the hashing function is another kind of cryptographic kind of measure of the blockchain system. And I guess hashing itself is not necessarily new, but its application in the blockchain does make it kind of a much more secure function. So the way a hash works is kind of any kind of length of string. There's a unique digital ID for each block. So I think the easiest way to look is, the example down below. So if I have a text string of ABC, once I hash it, I get a very specific string of characters. So basically what I would do is, when we're looking at validating transactions, we would look at the hash, because the hash is a unique ID for, each string. And the second example is, if I change anything in the string, even if I just change the ABC, just the C to the uppercase, the hash of that string is going to change. So that way I would know that something's tampered with. So instead of basically validating everything in the string and kind of comparing it to the, previous, like, oh, it's ABC, ABC, like I would just look at the hash, because the hash would instantly tell me if something changed. So I don't have to go through and validate, everything in the original one is the same, any uppercase, any lowercase, do a compare. I would just compare the hash. If the hash is the same, then I know nothing changed. That's kind of the other thing that makes blockchain relatively immutable. Can we go to the next slide, please, Bill? All right. So next, how does a blockchain kind of like get built, right? So how is it secured? I'm sure most of you guys have heard, I'll go back to the Bitcoin example since I think that's most prevalent in media now, is like hashing. So there's a concept of miners. Essentially, I don't know if you guys have seen, but people who farm Bitcoin, they have essentially Bitcoin farms, right? They would have racks of equipment that are basically built to farm Bitcoin, and it's kind of like specifically built, kind of like computer equipment that kind of facilitates kind of farming Bitcoin. And how it works is essentially when people mine for Bitcoin, they're essentially contributing their processing power essentially to kind of solve very complex mathematical problems. And there's basically a bunch of people who are contributing the processing power to try to solve a problem. And the first person that solves the problem will be rewarded with a Bitcoin, and they'll get to add their, be the one to be like, hey, I solved the problem. So this kind of incentivizes people to contribute as much processing power as possible, because the more processing power you add, the more likely you are to solve the problem, right? And this also kind of serves the interest of the blockchain, is because the more processing power that's on the network, the more difficult it is to crack, right? Because if you think about it, the more people, the more kind of parties that are on the blockchain, the more processing power you would need to hack even more kind of networks. So I think that's kind of the one kind of big thing, and kind of why Bitcoin is a very decentralized operation. So actually, there's a good question about, is it possible to know about the parties if we see the transaction on the node? So yes, it's possible. So kind of going back to my example, on the Ethereum network, there's a concept of the public key and the private key. So the way that the network's set up is, you have the public key, which is what we see, right? So for example, if Bill and I were doing a transaction, I see Bill's public key, and I'd be like, okay, I know that's Bill. So I know that that's him, so if I wanted to buy something from him, that would be, like, I know it'd be Bill.
Yeah, and I think that's a great segue. And I think in a couple of upcoming slides, we'll talk a little bit about what public blockchains mean and what private blockchains mean. So there's what Bradley has talked about with Bitcoin and Ethereum. Those are public blockchains. So I can go to any blockchain explorer, which is essentially a website that you can do to search transactions, and within the transactions you can see the parties involved. Now it's not going to be explicit with, here is this Bill sends Bitcoin to Bradley, but it's going to have the wallet ID and the transaction ID on there. And if I knew that this was my wallet ID, I would know that it'd be associated to me. So that's public blockchains, but we'll get a little more into what public and private mean in a couple of slides.
Thanks, Bill. Should we go to the next slide? So as I was talking about earlier, this is kind of the consensus mechanism, right? So again, one of the benefits of blockchain is everyone has a copy of the ledger. So yeah, it's decentralized, but how do we make sure that everyone has the same copy of the same ledger, right? Because if everyone has their own copy, then we have to basically be on the same page to kind of update simultaneously, right? So consensus is the mechanism that blockchains use, and this is kind of consistent across, the different kind of blockchains as well. There's kind of, Bitcoin, Ethereum, and other private blockchains. Consensus is kind of the same mechanism generally across all the blockchains. So again, you can look at these three steps. I'm not really going to read them verbatim, but essentially there's a few different ways of achieving consensus. So this proof of work model is, the mining that we talked about earlier. So Bitcoin is on proof of work, sorry. So essentially they're kind of mining and solving complex mathematical problems. And then the first miner to solve the problem gets their proposed block added to the next block, and they're rewarded. And then once that block is mined, then everyone kind of reaches a consensus and updates their blockchain accordingly. So that's the proof of work model that we predominantly see with a lot of public blockchains now. The one that's a little bit newer and that Ethereum is coming out with soon is proof of stake. So instead of mining for Bitcoin and contributing processing power, essentially you would be essentially staking your token. So essentially, say I have 20, 30 Ethereum tokens, I would essentially stake them when I'm validating the process. So the more tokens that I have staked, kind of similar to processing power, the more likely I am to be able to be rewarded with the the next block and kind of be paid for my efforts and my investment essentially. So a little bit of difference between those two, but again, very technical. So if you guys are more interested in that, would definitely recommend you guys look into kind of more subject heavy, content technical heavy material. Can we go to the next slide, please? So I think Bill, this is on you, right?
Yeah. Yep. I can cover this one. So what can blockchain be? So Bradley talked a lot about the basics of blockchain and what that means, but what are the actual benefits and what are the use cases we're seeing today? So the benefits, so peer-to-peer parties. So connecting those parties, we see a lot of our clients and they operate in different systems, even within companies, consolidated companies. For example, Coca-Cola. Coca-Cola has many different companies that operate within there, and they could have different IT systems or different systems of records that they're using and then consolidating up to their ending financials. So this is a way to use blockchain to connect peer-to-peer parties, and then using cryptography to supplement trust by using mathematics, and then really removing the need for central intermediaries. And I think that's a big key to a big key to remember whenever we're thinking about blockchain is trying to remove central intermediaries as much as possible. So where we're seeing a lot in blockchain is within supply chain management, shipping, logistics, food and pharmaceutical, safety, fractional asset ownership, rights and royalties management. So an example of rights and royalties management is EY has put together the blockchain for the Xbox rights and royalties management solution under our EY Opschain platform. So if you think about it, Xbox has their gaming platform, and users can go onto the Xbox gaming platform and they can buy a video game from a number of different gaming manufacturers, but ultimately Xbox is in charge of making sure that they sell the video game on their platform, and then they'll reimburse the video game manufacturers based off of sales that they've had on their platform. So if I'm a video game manufacturer, how do I know that the numbers that Xbox is giving to me on a monthly basis are accurate? One way we can do that is do an audit, but that can get pretty costly, right? So I'm one video game manufacturer. I have another one, say I'm EA Sports, and then say I'm another manufacturer, and then there's a lot of video game publishers on the Xbox system. So it could get pretty costly. So what we're doing is we're supplementing that trust by using blockchain, where all the members who are selling on the Xbox platform have access to the blockchain, and they're able to see their records real time, and they're able to reconcile where it might have taken a couple of days or weeks. They're able to reconcile what Xbox owes to the publishers within a matter of seconds, because they're all on the blockchain. They can all see all the transactions that are going on, and they can have access to it at any point. So it eliminates that need for a central intermediary, and it enhances trust because we have access to the records at all times. So that's a use case that EY has been a part of, but these are also many other use cases. And it's really, if there's a central intermediary, can we remove that by supplementing trust with my mathematics using blockchain? So one, I know I mentioned this, but there's 3 different types of distributed ledgers. So public, private, or hybrid. So public permissionless. So that's our classic Bitcoin, Ethereum. Ethereum has public pieces, but really there's a number of benefits, but there's no central intermediary. Read-write access is open to anyone, so anyone can be a member of this blockchain. Anyone can be a node on the blockchain. For Bitcoin, you're open. You're welcome to mine Bitcoin to try to append records to blocks, and this is a really where we're seeing a lot of the application developers work in this space. So there are challenges with each of them, but a lot of what we're seeing and a lot of what we believe in the future will take place on public permissionless, and I'll explain a little bit about that later. So also we have private permissions. So what we're starting to see is complex business processes are being managed for companies. So in the market, we're seeing a lot of companies, blockchain companies, go to big companies and say, we can have a blockchain solution and we will solve your complex business problem. And here's how we're going to do it. We're going to set this blockchain up, and all of your participants are going to be a part of this private blockchain, and it's going to be permissioned. So only this group will be able to use the blockchain, and then we'll have to provide access to this private blockchain. So it kind of replicates a central authority, and it's slow and costly to maintain. But also there's benefits where if you want to restrict the information that gets out to the public, it can all be stayed on this private blockchain. And then hybrid, there are hybrid blockchains that are coming out. They're not extremely popular, but we have seen that a little bit in the market. But going back to the public permissionless blockchain and why EY believes that public blockchains are the way to go is because if you're a company, you sign up for one blockchain, and then if you might sign up for another blockchain and another blockchain, it can get confusing, costly to maintain all of these private blockchains when we could use a public blockchain, and the public blockchain is sort of like EDI or the internet. Everyone has access to it. Everyone can transact on this public blockchain. But the real issue is we need to be able to privatize the information on public blockchain, but still be able to transmit information using that infrastructure. So that's where EY has invested a lot in what's known as zero knowledge proof technology. So if it's called EY Nightfall, which is what we've released out into the public, but essentially it's a set of mathematical problems where you go through, and if you can solve the mathematical problem, and the people who have the answer are the counterparty and the person initiating the transactions, those people will be able to see the transactions on that block, and and everyone else will not be able to see the transactions. So it's secure. It's privatizing the stuff that needs to be privatized on a public blockchain, and allowing the individuals who need access to that in that transaction. So it's a pretty interesting topic. I recommend people who are interested to check out EY Nightfall, and we've been doing a lot in that space as a firm. All right. So more and more blockchain solutions are starting to incorporate smart contracts. So smart contracts is unique to a blockchain. So what if we could have a contract that was governed by the rules of the blockchain, could be sent autonomously, and it could be secure and accurate, and we wouldn't need humans to ensure that we were meeting the terms of the contract. It could just be going automatically. So that's where really a smart contract comes to play, where there's predefined conditions that are met by specific parties that automatically trigger when a predefined transaction occurs on a blockchain. So what we're seeing a lot right now is with cryptocurrency transactions, and if a transaction meets a certain condition, the contract will execute and append the record onto the blockchain, and whether it be to buy or sell crypto, a lot of them are enforced with smart contracts. But then there's a lot of other use cases that are out there that we're seeing as well, where supply chain, where I have a price with the vendor, and based off a certain volume that I buy, I get a discount. So the smart contract can govern that, govern what the volume is, if the volume is appended to a node, and that can be governed by a smart contract, where we don't necessarily need a human to ensure that the terms of the smart contract or the contract are operating appropriately. That's going to be done with a smart contract. So because we have blockchain and we have records that are public, that everyone has access to, the smart contract really helps govern and initiate transactions on the blockchain. So we think that smart contracts are going to have a really big impact on the business world. It's been estimated that by 2030, so 10 years from now, over half of contracts will be executed via a smart contract, and I think that is accurate, because I mean, for my clients that I audit, their contracts are very costly to maintain, and the way to help automate those transactions will be done in smart contracts. So that's one thing that within blockchain that I think will make a big impact from companies from a daily day-to-day perspective. All right, so blockchains utilize tokens to store value as a unit of account. So I know we talked a little bit about mining. So there's a couple different tokens. So we talked about payment tokens and exchange of account that can be created through mining, or so that's traditionally your Bitcoin that is appended to. It's a payment token. You can pay someone 1 Bitcoin or whatever piece of a Bitcoin, but that you can cash it in for dollars or any functional currency, and that's a payment token. But then also we're seeing utility tokens and asset tokens, where maybe it's a fractional share of an asset, so it's a token appended to gold or vehicle or real estate, or it's a token as part of an application. So is this a token as part of a blockchain or a supply chain, where not necessarily an asset token or a payment token, but it's specific to that blockchain application. So there's different ways. So Bitcoin, it says cryptocurrency, it is not Bitcoin. Blockchain is a technology that underlies cryptocurrency, but there's many different tokens it can take place. So I think it's a good spot to answer the questions. So there was a question on, if no one is maintaining the network, where will the miner receive the reward? So Bradley, do you want to answer that one real quick?
Just come off mute. I mean, I think the way that the networks work is you would essentially have to have people interested in the network, right? Like the economic value of a coin. Sorry, Bill, there's some echo. Do you want to mute first, and then I can? So the economic value of a coin is really kind of based on how many people are involved, right? I mean, the coins intrinsically, if you think about it, Bitcoin itself wouldn't have any value if people weren't interested in it. So the way, I mean, right now as it stands, if no one's maintaining the network, that's kind of the miner's job to kind of solve for the network. And they'll get rewarded for their efforts. And if there's less people involved, then it's likely that the miners will get more rewards. So kind of analogizing back to kind of the original Bitcoin days, right? 5-6 years ago when Bitcoin wasn't really worth much, and sure, there wasn't a lot of people mining Bitcoin. Bitcoin was really easy to mine. You didn't really need a lot of processing power. No one really had a Bitcoin farm, right? So just by contributing, maybe your normal computer processing power, you were able to farm, probably a few Bitcoin, and there wasn't really any issues with that. But as more and more people got involved in Bitcoin, this is kind of where the technology started taking off. Is more and more people started chipping in their processing power, and the way that the Bitcoin and kind of the proof of work works is the more Bitcoin that gets mined, the more difficult it is for the remaining Bitcoin to be mined. So it kind of scales up in terms of difficulty. So nowadays, which is why you'll see, there's like Bitcoin farms and, just servers and racks of equipment just trying to farm Bitcoin, because the competition is so intense and there's, only a few million Bitcoin left to be mined. So the difficulty is, much higher. And that also, again, because the difficulty is higher, it goes into, towards securitizing the network as well. So kind of, flip the switch is like, yeah, it's difficult to mine, but that's because there's a lot of processing power. And that makes the network a lot harder to hack. So, take it back a few years when there wasn't really a lot of people kind of securitizing the Bitcoin network, that probably would have been much easier to hack back then if people wanted to do so. But again, the kind of the security of the network kind of corresponds to kind of the economic interest in the network, I think. And I think that's how I would think about it. Bill, do you have any thoughts on that?
No, I mean, I 100% agree. I think all the nodes are responsible for maintaining the network and maintaining the rules of the blockchain. So that's what's unique to the blockchain itself. So if we have everyone who's access a node and has offering their computational power, that's really where by following the blockchain rules and regulations, that they'll be able to determine who gets the reward. So no central intermediary, and that's what makes it unique to blockchain itself. So like I said, Bitcoin is a cryptocurrency. Bitcoin does not necessarily equal blockchain. Bitcoin is the technology that uses blockchain, but blockchain is so much more. Blockchain is distributed records, has a number of different use cases on the blockchain. So that's Bitcoin. Wanted to highlight that Bitcoin and blockchain are not necessarily the same thing. Blockchain is the technology. And then crypto exchanges serve as a platform to transact the digital currencies. So if you want to exchange or hold cryptocurrency, there's crypto exchanges that you can go to get access to trading cryptocurrency. So if you think Bitcoin's going to go up from $17,000, you can certainly invest in Bitcoin. But that's much like stock exchanges, there's crypto exchanges where you can transact digital currency. Okay, so you might have heard about initial coin offerings. So if you're curious, that's where really a method of raising funds by issuing tokens. This was really a buzz word a couple of years ago, where we were seeing a lot of ICOs pop up. And essentially, purchasers subscribe to buy tokens typically with cryptocurrencies. They receive tokens that can be used to transact on the blockchain solution. And tokens are recorded on the blockchain, and they're generated using smart contract. So whenever you initially do an ICO, you put together a white paper which describes the solution, and essentially they are unique to each ICO. So we don't see a ton of ICOs now. I think the market's matured a little bit from that, but whenever you see ICO, really, it's kind of like a new religion that's popping up, and that religion is backed by that white paper, and that white paper describes the rules and describes the what's occurring on this for this token as part of this ICO. So lastly, for overall blockchain, so I know we talked a lot about blockchain and sort of what it is, but I think when we're thinking about an ecosystem and sort of where we think blockchain is, we really focus, we have 5 different pillars that we align ourselves within blockchain. So one, our companies holding and transacting in cryptocurrency. So whether it be an asset manager, investment fund, a trader, you buy or trade Bitcoin. That's one pillar that we see companies doing. The next one is cryptocurrency exchanges, broker dealers, and custodians. So the exchanges who help facilitate trades and help facilitate the buying and selling of cryptocurrency. That's another aspect of this ecosystem. Companies initiating initial coin offerings, that's another one. So a company who is initiating their own tokens can put that in their ICOs. Companies who are developing blockchain-based business models. So like you're helping to put together miners, payment services, wallet providers. So you need a wallet to hold your Bitcoin. That's one other pillar. And then lastly, the traditional companies who are operating blockchain processes and consortiums. So helping implement enterprise and inter-enterprise solutions to help with a business problem. So this is where your supply chain, and this is where those processes come into play. And that's where we see a lot of the market moving into these traditional companies who are beginning to include blockchain as part of their business using this technology. All right, so that was a summary of the blockchain and sort of what the intro is. But I thought it would be important just to provide high level what an accounting firm's doing in blockchain, just to give some visibility into that. So I think Bradley alluded to this, but we believe that blockchains will do for enterprises and businesses, ecosystems, what the enterprise resource planning did for a single company. So we think this technology is going to be revolutionary. And ERPs have been around for the last 30 years. That's how businesses operate and do business, and they rely on their ERPs every single day to manage and create system of records. So blockchains, we believe, will have that same effect, and will have the similar effect for overall enterprises and business ecosystems, and will be the language for business in the future. So we're doing a lot with blockchain. So whether it be through our helping within our consulting practice and helping to start business applications and set up a blockchain, whether it be auditing blockchain solutions, whether it be professional services. This is just a little summary slide of sort of of all the features that we do. And what I do is, I mentioned I was a product owner for the blockchain analyzer. I support a lot of these functions to help organizations gain insight to what happened on blockchain. So we have clients who are using blockchain, whether it be in Pillar 1 or Pillar 2, where they're holding Bitcoin or their cryptocurrency exchange. We're deploying our analyzer to help gain insights into what's happening on the blockchain. So I mentioned this one as the Xbox rights and royalties blockchain, so I might have spoke a little too soon, but this is an example of one of our solutions that we deployed for the Xbox platform, UI Opschain, where we're using infrastructure to monitor the rights and royalties blockchain for the Microsoft Xbox platform, and something we're really proud to help Microsoft move forward with blockchain solutions. So like I've mentioned, you're moving from 45 days to 4 minutes to complete settlements of account when we're using blockchain technology, and also has less cost to administrate the system. So reducing costs by 40% to administer the system by using this blockchain technology. And we hope to get those costs down even further as we start building this out. So the one thing, what I support is I support the blockchain analyzer, and that is our analytics tools that we have, which connects to blockchains. So blockchains are complex, they're public, but how do we know what's been recorded on by the client is currently being present on the blockchain? So that's what our analytics platforms do, and what our blockchain analyzer looks to do. So this is just a quick thing, but we have our blockchain analyzer, which is our audit tool that we use to support and reconcile cryptocurrency transactions occurring on the public ledger. We're currently supporting over 100 clients, so it gives you some idea of sort of the scale of what clients are using blockchain, and helps us analyze 100% of the record, which is supported by our global audit guidance. So this is a lot of what I spend my time on, but gives you a sense of sort of this is real. Blockchain is here, and we're actually having real live clients who are using blockchain and seeing what this is all about. We also have our smart contract and token review. So if you go to blockchain.ey.com, which is our blockchain as a service platform, but what the smart contract analyzer does is it reviews a smart contract to make sure it's in accordance with ERC standards, and helping that make sure that what these smart contracts are coded appropriately, and making sure that everything is being in accordance with the regulations for Ethereum. So that's a product that's out there to the public. I recommend, if you're interested in that, to go to blockchain.ey.com and sign up. There's a lot of great resources, and you can have access to this tool as well. And then our tax calculator. This is another one that's getting set to, that is done internally, but they'll be getting set to release to the public shortly. The tax calculator is a way where you can calculate your gains and losses for tax purposes, and download a form, an 8949, because if you do get crypto rich, there's also taxes you have to pay on that. So this is a tool that we've developed, which is out there and will be released to the public. Currently available for clients that we're supporting, but we'll release more broadly in the upcoming weeks, and definitely stay tuned to blockchain.ey.com for that.
Can you pay your taxes in Bitcoin?
Not yet. The U.S. government does not take Bitcoin yet.
Okay.
And then this is the last tool I want to highlight that is now available and has access. You can get access to it. So this is an explorer and visualizer where I know there's like Etherscan, there's other visual explorers out there, but this is a sleek tool that has, you can type in your Bitcoin transaction and will show where the starting point was, where the ending point was, and really helps us analyze and visualize what the life cycle of this transaction is. So this one's also available out into the public right now, where people can get access to it. So I'll pause there for any questions. But like I said, EY is doing a ton in this space, and blockchain is going to have a huge impact to what we're doing as a business and how the business operates. And I think you'll start to see over these next couple of years, you'll start to see more and more of an impact. So it's good to understand sort of where we're at within this technology, and understand this will make an impact and start to absorb more of what's going on from a blockchain perspective, instead of just equating it to Bitcoin, because there's a lot of different opportunities that that are out there with this technology. Let me pause there. Are there any questions? Yep. So there's a question. So how should CPAs and future CPAs prepare for blockchain / AI reality? So blockchain, I think for a CPA perspective, they should know that there's different risk associated with blockchain. So the AICPA is doing a lot on, it's releasing a lot of guidance on blockchain. So talking about the audit risk, talking about the inherent risk with blockchain. Also with CPAs, there's going to be the future of what assurance looks like might change. So where we typically might report on financials on a annual basis, that could change to more of a real-time basis, and that's all because we have access to those records using blockchain technology. So I think the big thing for auditors now is to stay tuned, or young CPAs, to stay tuned to the release, the AICPA. They're very focused on emerging technologies, but then also to understand that this is going to make a big impact to profession. And then same thing with AI. I mean, we're integrating AI into a lot of what we're doing from a operations standpoint as a firm. So there's a lot that's happening there. So I think the thing with AI is or with any technology, is to know there's associated risk with that, and there's different opportunities. But to understand the technology, I think is going to be key for CPAs. I don't know, Bradley, if you had any other thoughts to that question.
No, I think you basically covered it. I think it's a big part of, I think our work is going to change in the future. So, the fact that, you're here and you're trying to learn about this topic, I think will go a long way. The change obviously won't happen overnight, but I think this is, a gradual change that, people will need to be more receptive to. And I think, you guys are in a great spot now because, this technology is developing. And by the time you get started, you won't have a fixed mindset of what people used to do. A lot of people at the firms now have a mindset of, hey, we used to do things this way, why are we changing it? But, coming in fresh, with this technology in mind, I think there's a lot of different perspective that you could bring, and I think that's very valuable. So I think, that's one of the things to also keep in mind as well. All right, well, I guess the next question is mining Bitcoin and cryptocurrencies legal? I think so. I mean, I don't know of any regulations in the U.S. that prohibit that. Obviously, we're not legal advisors, so I don't think we can fully answer that question. But I mean, I don't think mining is illegal, right, Bill, in the U.S.?
No, not that I'm aware of. So I think
Yeah.
I think you should be okay. But we're not like Bradley said, we're not lawyers.
Well, yeah, we're not lawyers, so take that with a grain of salt.
And then lastly, there's a question where if EY is focused on Ethereum and why it might be best. So Ethereum is kind of their end goal is really to kind of be the internet and to really have an online place where you can share transactions. And why it's different for Bitcoin is Ethereum, the standards, and they're really easy to build on. It's really friendly for developers to build on the Bitcoin, or the Ethereum protocol, and to build out new solutions on that protocol. Well, Bitcoin is very focused on just exchanging this digital asset. There's different applications within Ethereum, not that you can build out different business solutions. And there's a lot of developers in this space. There's a lot of people focused, and Ethereum seems to be the way that our firm has gone. And there's been a lot of a big focus on that as well. So I think it's very friendly to build on to help solve these complex solutions, which is what we're seeing a lot in the market. So that's sort of our viewpoint on that.
Yeah, and maybe just to chime in on that, I think the other thing to touch on is Ethereum is really versatile. So as Bill alluded to earlier, all of the information about all of the things that we're doing for smart contracts, those are kind of abilities that that Ethereum is able to do. And that's something that Bitcoin isn't necessarily able to do. I think most people make comparisons to Bitcoin as kind of a store of value, or essentially digital gold, right? And I think the better way to analogize Ethereum is that it's kind of more of a technology and a foundation, which you can do a lot of things. And when we were talking about ICOs earlier, a lot of ICOs are actually issued with Ethereum tokens, because the whole network and the versatility of Ethereum really allows for people to kind of customize and develop new solutions for them to kind of develop and roll out on the Ethereum network. So Again, that's kind of why we think Ethereum is kind of the best public network. And I think we've also kind of spoken briefly about why we think public networks are the one going forward. And also Ethereum has a great, huge development, a lot of developers working on it as well. And there's not necessarily a central authority on that as well, which we also think is another key part of public blockchains. So, Bill, I think there's one more question about, so how will a private distributed ledger use tokens? Will they allow public individuals to utilize tokens, or will it be built upon by the company itself? So I guess maybe I'll take a first stab, and then Bill, maybe you could chime in to add in. So the private blockchains that we're talking about, I don't know if we talked about, for example, one of the ones that I think IBM is working on is, they have a consortium where they work with several food companies. I think it's called the Food Trust, right, Bill? And then basically, they have their own internal blockchain. So in that case, it's like they basically set the permissions, right? They invite the companies. They're like, okay, you could be a participant in our blockchain network. So that way they know who's who for everyone. And, technically, sure, it's relatively more secure because it's private and, random people can't access it. But again, you have the central authority problem, which, we've talked about previously with the ERP system. So if it's a private ledger, a private blockchain, then, they can decide who to allow into the network, which again goes back to our central authority problem, and which is one thing that we think public blockchains have the benefit of. Like, yes, it's censorship free, but also anyone like yourself or I can participate in. But private networks are built by companies. So, for example, for IBM developing the blockchain, they're going to have a lot of development research costs that they have to incur. Whereas for Ethereum, like a network like this, the cost is kind of shared across everyone. It's not like there's a central company that's shouldering, paying like tens of thousands of people to develop things on the Ethereum network. There's a lot of developers out there that are kind of doing it kind of independently, and that kind of widens and broadens the cost of the, I would say, kind of IT infrastructure. And that's one thing that the private blockchains have as a disadvantage, because they have to essentially fund everything themselves, as opposed to Ethereum, where there's a large network of people that are essentially funding it.
Yep, no, 100% agree, Bradley.
Well, great. Thank you so much, Bill and Bradley, for sharing your insights and expertise today. I know we're all busy working from home, and I'm sure your schedules are packed full of work and also personal things. So we appreciate you taking time out of your day to join us. I want to thank everyone here, also the audience, for your questions and for your insights. Again, we'll be recording this. We are recording this, and we'll be uploading this on our CalCPA YouTube channel. So go ahead and check that out when it's uploaded. Thank you so much, gentlemen, for your time, and we hope to engage with you again.
No problem at all. Thanks, guys. Appreciate it.
Take care then. Bye-bye.